All right. So good afternoon, everyone. My name is Tim Hilligus. I want to welcome you to our webinar on the PPP loan program. For those of you who are not familiar with our firm, for 17 years, I hosted our CFO roundtables. Clayton McCurvey hosted quarterly roundtables where topics like this would have been the norm. This would have been something we would have brought on board and brought an expert in like we have today with Sarah Russell, one of my partners, and shared what were some of the dynamics of this operation. So a little bit of background. Well, let me ask this. So why don't you go ahead? I can see everybody out there. Why don't you raise your hands? For those of you who are familiar with our firm and the roundtable, go ahead and raise your hands. Okay. I see Angie. Good. Anna. Fantastic. So for those of you who aren't familiar with our firm's been around for over about 60 years. And for the last 40 years, and Sarah and I have not been involved with the firm for the last 40 years. For the last 40 years, we focused on closely held businesses. And so that means there's a lot of things we don't do. We don't work with typically not-for-profit organizations or highly regulated organizations like insurance companies or banks and governmental agencies. So what Sarah and I do every day is focused on closely held businesses. And I can tell you this topic is the #1 topic within our client base. It's something we've been dealing with every day since the exception almost about a month ago, from that first 5-day window when applications started being accepted on April 3rd. I personally have worked with companies from $20,000 PPP loans up to $9 million in loans. So the one thing we know is the process is pretty much the same. The differences, and we'll talk a little bit about those in a summary. What are some of the differences and some of the things you need to be thinking about? First thing I wanted to cover is a little bit of housekeeping. It's a webinar. We're doing our best here. Hopefully, we'd love to get your feedback on the process from the registration, the feedback on the email, the ease of asking questions, the ease of the software. So we'd love to get your feedback on that. Second thing is, for those of you who are used to coming to our CFO roundtables, we are going to end right on 4 o'clock. We know everybody's busy. We're going to try to get to as many questions as we can, and we are going to take questions real time. So we definitely want to encourage you to ask questions because more than likely somebody has the same question you do. And frankly, as much as Sarah and I have dealt with this program in the last month, there may be something we haven't thought about, and frankly, it's changing continually. So definitely would love to get your feedback on the program. We're going to end on time, and we are going to take questions throughout the program. There are an infinite number of hypotheticals, and this is a unique situation. With many tax laws and tax legislation that come in, what Sarah and I are used to is we're used to the Q&As, the regulations that kind of clarify this. And at this point, there's still a lot of ambiguity. So we expect hypothetical questions, but considering all the uncertainties, there may be some things we don't necessarily know the answer to, but hopefully we'll put you in a position to where you're in the best situation to maximize the loan forgiveness and maximize the benefit of this program. I want to talk a little bit about one other consideration and one other thing we're proposing here. We would like for all of you to save this date. Save the Wednesday at 3 o'clock throughout the month of May. If you've watched other seminars or talked to other professionals, you know that this information is changing every day. As a matter of fact, as late as last night, we now are up to question 37, and I'm going to ask Sarah to nod. Are we still just at 37? So we're still just at 37. So this information is changing daily. So we're proposing to have a 3 o'clock webinar for the Wednesdays throughout May until we can hopefully answer all the questions and get through this and put you guys again in the best position to be able to maximize the loan forgiveness. I also want to talk about some things that we probably won't cover today, but we may cover in the future, and some things that you'll have to prioritize as CFOs, controllers, business owners, whatever your role is in your organization. And that is the non-forgiveness, the non-tax, the non-loan itself aspects, and that's the accounting. How will these be handled for accounting? We're hoping to get some guidance on this in May. How will it affect your interim loan covenants? How will it affect debt coverage or or leverage coverage ratios that you may have. So please don't lose sight of those types of things. We understand right now probably the most important thing everybody's thinking about is the forgiveness aspect and how do we calculate that. This has changed a lot. We had 5 days from the inception of the law for applications to be started, and continual questions. And the questions that come to my mind or the issues that as a professional have come up. Question 7 on the original application really denied a lot of mine and Sarah's clients an ability to even apply. The application changed within a few days. And now as we said, we're up to question 37. As recently as the last few days, you've probably heard question 31, question 37 have now addressed issues related to people that maybe don't need these loans. And you've heard about the LA Lakers and probably Shake Shack. So the SBA and the Treasury Department are continually making changes to what the guidance and what the rules are for the payroll protection program loan. There are some things you probably have all dealt with. You're either in phase 1 or I think it's called phase 3 and phase 3.5 of the legislation. Hopefully, we're at a point where you've got an ability to map out your forgiveness, your loan forgiveness calculations, or have a timeline to be ready for that. And that's what we're hopefully going to cover today. But a lot has changed. A lot of complexities and a lot of ambiguities and a lot of changes have occurred between both the original act, the CARES Act, and the Enhancement Act. So hopefully we'll have some good information that will help you get through this. And I also want to emphasize your bankers' roles. So as many of you probably read the Wall Street Journal, New York Times, Detroit Free Press, Cranes, a lot of discussions about the challenges with this program. The best way for this program to get implemented and brought out to small businesses was to use the program that existed, which was the SBA program through your local banks. And that's the program we were all used to, whether it was the traditional 7A or 504 loans. And that's the infrastructure that was developed here. Now, I'm not going to discuss specific situations, but the banks play a role in this, and each bank has their own subjective criteria. They're going to have their own processes and procedures. So as you're working through this, I encourage you to make sure you talk to your bankers, make sure that you understand what do they need. They've been on the front lines from helping you determine the loan that you qualify for. They've helped you with the application process, and hopefully they've also helped define for you what was the information they needed in order for you to assist you with your application. Now on the backside, they're going to be involved in the process of forgiveness. They're going to be the ones that are initially going to determine that amount, and also you'll be submitting your documentation to them. So understand that each bank may have various levels of criteria or various levels of information that you're going to need to provide. And the last thing that just happened, for those of you that will be looking for forgiveness in excess of $2 million, the Treasury Department has announced that they will be auditing or reviewing all of those requests for forgiveness, $2 million and greater, and will be subjecting those to audit before forgiveness is determined. So keep that in mind when it comes to the documentation. So that kind of leads us to where we are today, the forgiveness discussion. I can't emphasize enough, it's a moving target. What we've put together is the information we think helps bring this to light and answer many of your questions. We may not be able to answer all your questions. So you've heard me talk enough, so I want to turn this over to Sarah Russell. Sarah leads our Clayton McCurby's tax department. She has really been our eyes and ears for our clients and my fellow partners and senior staff and managers in addressing all these issues. So Sarah.
Thanks, Tim. I wanted to sort of add, and I think Tim probably sort of covered it. You know, we've done a few webinars with our partners as it relates to the initial rollout of the program. So we've covered a lot of detail on some of the definitions that are included in this program. We're not going to go over those again today. Certainly, if you have questions in that regard, feel free to reach out to Tim or I, and we're more than happy to address those questions. That's just not what we're here to cover today. Mostly, we're going to focus on the issues you should be considering now that you've gotten funded or are anticipating being funded in the next few days here. Hey, Ryan, our slides aren't up. Thanks. So just to recap a few things, where the PPP program stands as of April 16th, 2020. The SBA announced this. They've issued just over 1.6 million loans with net approved dollars of about 342 billion. And that was processed through about 4,975 lenders. We do know that with some of the recent announcements that we'll talk about in a few slides here, there are some public companies, Shake Shack being one of them, some large private companies, the Lakers being one of those, that have announced they will pay back the funds that they were originally approved for. The SBA has indicated that that will add about another $2 billion of availability to the funds as they approve this next round of funding. So the second round of funding opened yesterday at 10:30 in the morning. As of 3:30 p.m. Monday, the SBA announced that more than 100,000 PPP loans had been processed by more than 4,000 lenders. So that was just in the first 5 hours of the program. We anticipate that this program will run out faster than the first program because the banks are now set up to handle that volume. The SBA did issue a mandate that said each lender could only submit a maximum of 350 applications per hour. However, we've anecdotally heard some banks are submitting 5,000 batch applications at a time. So I'm not sure how the SBA has been implementing that mandate of only allowing 350 applications per bank per hour. We know that there's still challenges with the E-Trans system that the SBA uses to process this loans. Because of the volume of loans, that system continues to experience outages as they sort of try to process through the volume that they're getting pretty rapidly here. All that being said, I would say it's not too surprising. You know, Tim mentioned that this law got passed and 5 days later, the SBA was up and running to start taking applications. In 2 weeks, the SBA processed more applications than they did in the previous 10 years. So I think it's not surprising to say that there've been some hiccups along the way and there've been some problems. I think all in all, they've done a pretty good job. So Tim alluded to some new guidance that's been issued. On April 24th, there was interim final rule on requirements for promissory notes, authorizations, affiliation, and eligibility issues. That covered some of the guidelines around private equity fund and hedge funds and who was eligible there. On April 26th, FAQ 31 was issued to address large companies with adequate sources of liquidity obtaining these loans. And that has caused quite a big stir in the media, as well as in the accounting profession, the legal profession. People are trying to interpret, what does this mean? And do I have an issue? And unfortunately, the answer is we don't really know at this time. You know, the FAQ 31, and I'll read it to you, indicated that a borrower must take into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to their business. The FAQ specifically indicated it was unlikely a public company with substantial access to capital markets would be able to make the required certification that's in the original loan application in good faith. And they said that borrowers should reassess their certification under this new guidance, and they have until May 7th to repay the loan if they believe they no longer qualify. And in that instance, they would be deemed to have made that certification originally in good faith, and there would be no harm. FAQ 37 was then issued yesterday, which sort of piggybacked on FAQ 31, and it made clear that those rules would also be applied to businesses owned by private companies with adequate sources of liquidity. I think that the intent of these FAQs is to prevent the publicly traded companies who certainly have access to capital, as well as some privately owned companies that also have a fair amount of access to capital from try to prevent them from continuing to apply for these loans and maybe encourage them to repay the loans that they have already gotten. You know, if you think about the Lakers receiving one of these loans as a private company, certainly they met the qualifications under the guidance that was issued at the time, but there are some concerns that maybe they shouldn't have been applying for these loans. So we don't know what the definitions of what does access to sufficient sources of liquidity mean. We don't know at this time. We could speculate, but until we get further guidance on where they're trying to go with this, we can't really say. So going back to
you know, that was the number one question right now being asked is what are the guidelines to establish that it was indeed necessary. So that clearly is a concern for most of our participants today.
It is weighing on everybody's mind, I think. You know, you could, and we'll talk about this a little bit later, but you know, you could argue, right? Well, Ruth's Chris Steakhouse, for instance, right? They are one of these companies that has been publicized about taking advantage of the loan program. And certainly the legislation carved out restaurants and said that they did not have to meet the 500 employee threshold, and they could deem by location whether or not they were qualified. And I think it's hard to argue that restaurants aren't economically impacted by COVID-19. They are not allowed to be open. So while they've gotten bad publicity because they're publicly traded, the intent of Congress seemed to be focused on allowing them to have access to this capital. I don't know where we're going to end up. I think it's probably going to be somewhere in the middle. Ryan, we've lost the slides again. I think you are not on the right one. You can stay there for just a moment. Sorry about that. So all of this being said, you know, you can see that there's been a lot of guidance from April 24th. Yesterday, there were 3 pronouncements alone. Tim talked about the $2 million, loans over $2 million being audited. We'll see where this all ends up. We are keeping track of it. I am constantly on the Treasury website refreshing for guidance. We told Brian, who's helping us with our webinar today, that we would get him the slides, but maybe not until 2:30, because if there was more guidance issued today, we wanted to make sure that we talked about it. As of 2:30 today, there is no new guidance compared to where we were last night. So we'll keep you informed, and we will certainly be issuing blogs as we get more information. And as Tim mentioned, in these weekly webinars, we'll keep you up to date as to where we are now. So let's talk about loan forgiveness. I want to go through a sample calculation and then talk about some of the questions that we have surrounding some of the definitions included in the legislation. We expect guidance to be issued soon, although we expected it to be issued before April 26th. The legislation that was originally issued said that the administrator had 30 days to provide guidance. That hasn't proven to be true yet. And I sat in on a webinar earlier today where all indications seem to be we're still a week away from getting our initial round of guidance. And we suspect that once guidance related to loan forgiveness comes out, it will come out and continue to come out over time. So we'll get one large wave of guidance, and then additional guidance will continue to follow. So I don't anticipate all of our questions will be answered in that first round. I think we're still a few weeks away from having a lot of clarity on where we will end up here. What we're sort of suggesting to our clients is to plan for the best case scenario, meaning plan ways to maximize your loan forgiveness if that is the most important factor to you, but prepare for the worst case scenario, meaning you can plan for strategies to use the cash in the way it's intended to be used in the 8-week period, but also prepare that maybe some of those strategies you are planning for may not work. Once the guidance is issued, they could certainly say, that's not what we want you to do. and issue some regulations that would prevent that. I am telling all my clients to prepare for that, but don't actually have the cash going out the door until you know what's going to happen. Hopefully, before we get to the 8-week period being up, we will know where we stand. So with that, I'll jump into this example here. So when I first started to help some of my clients calculate how much do they think loan they'll have forgiven, there was a lot of surprise. I think everybody assumed at some point that 100% of the loan would be forgiven if it was used for payroll, rent, utilities, or interest on mortgage obligations. But what we're finding is that a lot of our clients can't spend all of the money in the 8-week period. And that 8-week period begins on the day you get the disbursement. So you have 8 weeks from the day of disbursement to use these funds. And that's your pool of funds that are eligible for forgiveness. So to the extent that you have funds that you did not use, you will at the end have a loan that will have to be repaid. So in this example, we have a maximum loan amount that they took out was $2.5 million. And during the 8-week period after loan disbursement, they will use $1.85 million for qualified payroll costs, $150,000 for rent payments, and $50,000 for utility payments. They had qualified interest payments of another $50,000. So their total eligible for loan forgiveness was $2.1 million. And that's the first threshold that we look at is how much of this money am I going to be able to utilize in the 8-week period following the day I got the loan. So in this instance, we have $400,000 right off the bat that is not going to be eligible for forgiveness. So if you go to the next slide, we look at in the loan forgiveness rules, there are some guardrails around when you have to take a reduction in your amount eligible for loan forgiveness. So remember, we started with $2.5 million loan. We're now down to $2.1 million that is eligible for forgiveness. We now need to look at those other guardrails. The first guardrail is you have to spend 75% of the loan on qualified payroll costs. To the extent that you do not spend the loan on payroll costs, it will not be forgiven. So if you, in our case here, out of the $2.1 million, we spent over 1.8 on payroll costs. So we were above that 75% threshold. So this example doesn't have that. If that $2.1 million, if there was less than 75% spent on payroll costs, you would have an additional bucket of amounts that were not eligible for forgiveness. So to the extent your non-payroll costs were 30%, you would have a 5% differential here that would not be forgiven. So that's the first guardrail. The second guardrail is there's a clause in the rules that indicate that you have to keep your full-time equivalents consistent with a base period. And that base period is either February 15th, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. That election is an election that the borrower gets to make. So in this case, it's February 15th, 2020. There was 200 employees, and I guess that should really read February 29th, 2020. And at the employee count at June 30th, 2020 is only 180. So we're looking at it saying, hey, the head count here is only 90% of what it was and in the base testing period. So we will have a further reduction of loan forgiveness of $210,000. And that is 10% of the $2.1 million available for forgiveness. So we started with $400,000 that wasn't going to be eligible because we didn't spend it. And now we add another $210,000 to it. So in this case, about 25% of the loan ends up not being forgiven. So I think it's important to keep those details in mind as you're projecting how much loan you think you will have forgiven. Are there any questions on that, Tim? We good?
I think we're good on that so far, yes.
Okay, perfect. So now we want to get into what questions do we have as professionals who are advising our clients? What questions have we seen come in from our clients? And a lot of these questions we do not have the answers to. The biggest questions we have are covered expenses accounted for on a cash or accrual basis? This will be an important question when when you start looking at if it's a cash basis, do you need to run a special payroll to make sure you maximize your payroll costs? Do you need to make sure you're paying your rent? Can you prepay rent? But there's also a clause in here that says forgiveness is equal to the sum of eligible costs incurred and payments made during the covered period. How will that be defined? We really don't know. But, some hypothetical questions we've had is if March rent was paid after loan proceeds were received in April, can we use the proceeds to pay March and that will count towards forgiveness? Can I pay a 2019 profit sharing that I generally might not pay until September of 2020 to make sure that it's tax deductible? But can I pay this during this 8-week period and have that count as my payroll cost to be forgiven? And if the answer to that question is no, but I'm intending to make a profit sharing contribution at some amount for 2020, can I make that profit sharing contribution in 2020? I think the devil will be in the details here as they issue our guidance on how will incurred and paid be defined. We anticipate there'll be a little bit more clarity. There's also some questions. Does rent include real property only, or does it include real and personal property? If it's only real property and you have a triple net lease, can you then include property taxes and your common area maintenance costs? What if you have late fees? These are all questions that we just don't know.
So Sarah, let me just jump in here for a second, because the number one question right now is, and I think it's consistent with the incurred and paid, and that is, can you use the PPP loan to pay bonuses?
I think you can, but I don't know.
Yeah.
It probably goes back to this incurred and paid definition. I think that if you're paying bonuses to sort of like hazard bonuses to encourage your employees to come back during these social distancing times, and so you're going to give them a little bit of an extra bonus to help make that happen, that it would be hard to say that that bonus was not incurred and paid during the period. However, if I think you have an annual bonus program that's determined at the end of the year, there could be some argument that those bonuses the expense for that bonus has not yet been incurred, and potentially it won't be included.
I think there's two other things that come to my mind. Number one is, bonuses are payroll. And so from the standpoint of it being a qualified expense or a use of the funds, I think it would meet that. I think the uncertainty of the incurred, I'm not sure I'd want to put myself in having prepaid bonuses paid within that 8-week period. But I do think if you got bonuses that have been earned, and as you described, is there a retention bonus or a hazard type pay bonus? I certainly think those would be qualified. But also consider that you still have those limitations. You still have the limitation of the equivalent of $100,000 of wages. So when you're still factoring in what's the forgivable part, you've got to weigh all those things in. And I know that as we've talked to clients and had this dialogue, the fact that we're still juggling the accrual versus cash basis, we've talked about having a final payroll on that last day of your 8 weeks, and this may be something you're looking at. Have there been bonuses that have been earned in that period that need to be paid? So not black and white, but I think that's probably some pretty good advice there.
I don't disagree. And I do think that, if we keep going back to the intent of the program, which is paycheck protection, to the extent that you're using these funds for payroll purposes, I think the better position you're going to put yourself in, even upon an audit. I do anticipate that there will be a fair amount of guidance around this incurred and paid. I think we'll get some definitions there and some clarity there. At least I really hope we do. But I continue to err on the side of, if you are paying your employees, you are putting yourself in the best position to show that you have properly used this program. I think one of the other questions that's coming up, that I see from a lot of my clients is, hey, I have a payroll that's coming due, right? 2 days after I've gotten funded, is that going to count? And that goes back to, well, was that payroll incurred during the covered period, which is the 8-week period after the loan, or not? And, we just unfortunately at this time can't answer those questions.
Great. Let me throw one more in here because it kind of goes into the definition of payroll, and that is, do premium payments for short-term disability, group life insurance, in other words, do group programs, group benefit programs fall under the criteria for payroll?
Yeah. I mean, it's clear that healthcare benefits do. What is not clear is whether that is going to include disability and life insurance. I think that at this time is uncertain.
Great.
One of the other questions that I get a lot is, well, what happens if I don't use my funds before June 30th on eligible costs? You didn't use them on anything else, but you didn't have enough eligible costs to use those funds. And you intend to use those funds after June 30th for eligible costs for payroll after June 30th. It's just you weren't able to use them in that covered period. What is going to happen? I think the answer is that, it just turns into a loan that has to be paid over 2 years at 1%, and you get the first 6 months deferred. But there is some talk out there that some people believe that you would have to be required to pay that loan immediately. I think that that's a pretty conservative viewpoint, but I suppose that anything is possible. I said before that the administrator and the Treasury have certainly taken some liberty at interpreting the rules that they have been given to deal with. And so I won't say no, that's not possible. It just seems unlikely to me. So if we start talking about, and Tim alluded to this, eligible payroll costs, what are those costs going to include? Are they going to include the short-term and long-term disability and life insurance? Are payroll costs net of Section 125 reimbursement for healthcare premiums? Do payroll costs include deferred compensation payments? If you have somebody on a 409A plan that's receiving monthly payments, is that deferred compensation going to be deemed incurred during the 8-week period? We don't know. And Tim and I both have already said, there's a lot of discussion. Is an employer going to need to run a special payroll to maximize their payroll costs during that 8-week period? I'll say it again, we expect more guidance to come out, and hopefully sooner rather than later. So, the sooner we can plan for these things, the better off everybody will be. I don't think there's any doubt about that. A few other questions I've gotten, as it relates to payroll is, will there be a comparison to prior year to see if there are unusual payments? And this goes back to those bonuses. Certainly if you're paying a hazard or retention bonus during this period, I don't think that there will be any question on that. If you're pulling forward year-end bonuses, there could be some questions there. Will they compare employee records to prior year to audit to see if you are bringing on spouses or children or family members to up your FTE count? I don't know. We'll see what happens and what kind of guidance comes out.
Yeah, we have a bunch of questions that really relate to this. I'll call it the cutoff issue of incurred and paid or payments, whether it's utilities where your 8-week period straddles or encompasses 3 months. Maybe you can address the fact that similar to what you've already stated, it's really uncertain at this point can you go beyond the incurred aspect, regardless of if you're making 3 payments, correct?
Correct. Yeah.
And so I see a lot of people are asking a lot of questions about the 3 months, and the question also revolving around when does the 8 weeks start? Well, the 8 weeks starts on your funding date. So while that was one of the uncertainties we had from day one back in March, where we wondered what was that initial date, or what was your the term's escaping me right now. So
Origination date.
What was your origination date? Your origination date has been determined to be your funding date. So that's your first day of your 8-week period, and that's where you're going to want to map out all these issues we've been talking about. Sarah and I have been advising our clients, look at the month before, look at the month after, because we are not certain, will they take more of an accrual type look at this and look at a period before or a period after for items paid to really assess what's the true benefit that you're entitled to. You know, we talk about this term in tax law a lot. What's the intent of the legislation? The intent in the legislation was to capture your legitimate expenses. And unfortunately, we're in this gray area where we're not knowing if you have to use a cash method of analysis or an accrual method of analysis to determine what's the true ultimate forgiveness. And hopefully, you know, I'm going to be optimistic. Hopefully we'll get clarification as this continues on.
I think we will get clarification. There's no doubt in my mind that we'll get some clarification. It's just what degree of clarification we get before we start applying before our clients start applying for forgiveness. I want to say the other thing to note is, you know, in the actual legislation, there is a rule in there that says once you apply for forgiveness from your bank, they have 60 days to make a determination. That's not in interim guidance that's been issued. That's not an FAQ that's been issued. That is actually in the legislation that was written. So I'll be interested to see how the SBA is really able to implement this announcement that the secretary made yesterday, that all loans over $2 million will be audited before they will be forgiven, because that means they'll have to be audited within 60 days of when a business applies for forgiveness. And I think that they're going to really be challenged on doing that. I don't think that they will have the resources. So I do think that they are going to probably really be picking out the high profile borrowers that are in that pool. And they'll probably go down the list, and they'll start with the highest loan dollar values, and they'll go down and start auditing. But I think it'll be really, really hard for them to audit every loan above $2 million. I just don't think they'll have the resources. And I don't think that they have the authority to change that legislation. I think that would have to come out of a congressional bill. So not that that's out of the realm of possibility, but I don't think it will be as easy as some of these other pronouncements that they've come out with, because it is written pretty clearly in black and white in the legislation that was issued. Getting back to, you know, some other questions we have, are there any limitations on self-rental? There are no limitations that we can see in the legislation as it was written, or in any of the guidance that's been issued to date as it relates to self-rental. However, I wouldn't be surprised if we see some guidance come out that says, you know, if in the event you have self-rental, the amount of loan forgiveness is going to be equal to the amount of mortgage interest paid on that property. That would be my logical conclusion if they issue any guidance on that to dissuade this self-rental from being included. That being said, I also recognize that there are a lot of people in power in our government that hold a fair amount of real estate and are probably have a fair amount of self-rental going on. So it's possible that that rule gets overlooked and ends up being favorable for some of our client base. Not listed on here, but one of the questions that we get a lot is what is included in covered utilities. It's clear that telephone and internet service is included. There's transportation utilities included. I don't really know what transportation utilities means. I haven't been able to find a definition of that. Is it meant to include, you know, like public transit, or is it something else? I'm not really sure.
That's a very popular question online right now. And the best answer I've seen in talking with colleagues and peers, and again, it is not defined, has been fuel costs for transportation vehicles within your corporate vehicle fleet. So whether you're a trucking company or a sales force, I'm not sure, it's not defined, but the best interpretation I've seen was fuel costs.
I think as with everything else, it's undetermined, right? And then there's a lot of questions surrounding how will the FTE 25% wage reduction rules work? If you have a reduction during the 8-week period, or if you didn't have a reduction during the 8-week period, but then you did before June 30th, but through that full 8-week covered period, you were fully staffed. Do you still have a reduction of staff? The way I read the legislation, the answer would be no, because it clearly, to me, right, and this is just my interpretation, states that the covered, you count the employees during the covered period to determine if there's a reduction. There's just been a snapback rule included in the legislation that says, but by the way, if you did have a staff reduction and you reinstated all employees by June 30th, the administrator will deem that layoff never happened or it had been eliminated. Similar to this 25% wage reduction rule. So I think the answer is, if for your full covered period, your FTEs were the same as what they were in your base period, you would be okay, even if there was a subsequent layoff. But I'll hedge my bets and say I'm not 100% certain that will be the end result of this legislation. We talked about, will there be any comparison to previous periods to assess for reasonableness? I don't know. I think that would be a more difficult one, just because of where we're at in the world today. I don't know how they would compare. And you certainly have some companies that are fully operational because they're an essential business that are paying premium rates or premium hourly rates for their employees to continue working. So I think that would be a pretty tough one for them to do. But there may be some auditing on who's included in those FTEs, if anything.
Yeah, this is again another popular question, Sarah, where people are probably not clear on the intent. The intent of the legislation was to make sure companies retain employees or bring employees back that they may have already laid off, and they're using that June 30th deadline as a measurement tool. So, you still can only get forgiven what you've paid, but if you've laid off your workforce and you're looking for forgiveness, that June 30th is kind of your last measurement point, as I understand it, correct?
That's to me sort of a catch-all, right? When you look at the way this legislation is written, almost throughout the entire legislation, the covered period is February 15th, 2020 through June 30th, 2020, with the exception of this loan forgiveness. And in this loan forgiveness, in those rules, the covered period is the 8-week period after disbursement. So you're dealing with two covered periods, right? You're dealing with loan forgiveness, which is this 8-week period, and then you're dealing with the covered period in which I don't fully understand, but which you're allowed to spend or you're allowed to use the funds, right? You're allowed to use the funds for costs incurred between June 15th, 2020, or between February 15th, 2020 and June 30th, 2020. So that June 30th, I think the legislator wrote that in because they thought, well, this is the worst case scenario where we'll be, when they started passing legislation, I think they thought we'll be back up and running as a country sometime in May. And so this will provide some cushion before we get back up and running, and inherently thought everybody will certainly be fully in operation by June 30th. So they wrote this June 30th rule to say, well, if you had some payroll costs, but not fully, as long as your FTEs were reinstated by June 30th, you'd be okay. But when I read the rules, it actually clearly states to me, again, this is to me, that the covered period for purposes of counting your average FTEs is the 8-week period after you receive the loan. Mm-hmm. And that June 30th is meant to say, if you still had a layoff during your covered period, but you were able to reinstate everybody by June 30th, you would not have to reduce your loan forgiveness. That's how I read the rules. It doesn't seem that unclear when I actually read through the legislation, but I know that there's been a lot of talk about what that really means. So I don't know, but I don't think that you have to. I think you could have a subsequent layoff. I think that there will be more to come. Certainly Congress is already talking about phase 4. I've heard on a couple of different webinars that I've participated in over the last week that it's going to be even larger than the CARES Act, which was $2 trillion. Seems hard to believe, but also not considering where we're at today. I think, we'll see what happens.
Hey, Sarah, one of the questions that keeps popping up here is the fact that in the period to determine the wage comparison, it's the last completed quarter. And, quarters are 13 weeks. When you think about cash flow, 13 weeks per quarter. When you think about payroll costs, it's 3 months. And so is there a definition of when you're comparing that wage comparison in the first quarter? Is it need to be modified to take the first quarter or the last quarter completed and convert it to an 8-week equivalent and compare it to the measurement 8-week period? And you're looking at me like I'm an alien there. So
no, I'm not following the question.
Well,
and maybe this is just because
one of the criteria for determining keeping your compensation at certain levels to meet the qualification is if I kept my people's payroll at 75% of what it was in the most recent quarter that was completed. And for all the ones you and I've been dealing with, that's going to be the quarter ended March 31st. And a quarter for payroll is a 3-month period, but we're comparing it to an 8-week period.
I believe that what they'll look at is if you had an employee who was making $52,000 a year, we'll just make it easy, right? They would look at, okay, for that period, he made $1,000 a week. And then they would look at what the weekly payroll was in the 8-week covered period. And that's how they would compare it. Yeah. That's what I think, but.
I agree with you. I think that the advisors that I've listened to, including ourselves, but also talking with controllers and CFOs and HR directors, there's going to be some algebra. You're comparing an apple and an orange when you look at the comparability of a quarterly payroll report and an 8-week period. So what I interpreted is they need to be consistent. And if the measurement period is 8 weeks, you want to have the comparison period to be a similar 8-week equivalent.
Yep, I agree.
So I just want to chime in real quick. For those of you who used to come to my CFO roundtables, it was so much easier to see you raise your hands, see you ask questions, or if there were no questions, pick on a few people, pick on the people I knew. One of the real challenges I'm having is getting through all the questions and trying to link them to Sarah's presentation. So I'm going to let Sarah take control here a minute. And if you want to get through some more of your slides as we're at the 3:50 mark, I'm going to go ahead and let you do that. And if I see something specific, I might chime in. So.
Okay. So when we think about other so I'm going to sort of move on from questions. I gave a lot of hypotheticals. We could give a ton more and talk about all the different questions we've brainstormed over the last few weeks. But I think you probably get the point. It's pretty much undetermined at this time, and we will for sure be keeping you informed as we get any guidance that comes up. So now if we shift gears a little bit and think about what other things should I be looking at in regards to PPP, everybody's really focused on loan forgiveness. And I would just say, be careful about that, because it may make sense for you to, in assuming we don't get guidance that says otherwise, to keep the loan use it for payroll costs, right? You still only use it for eligible costs, but maybe you use it in the future. Maybe your cash flow, you could project out your cash flow and it doesn't look like it's going to be that great, or you're going to hit up issues on your line of credit because you know that payments from your customers are going to be coming in slower. It's going to take you a while to ramp your business back up. In the meantime, you're going to need to buy inventory and have a lot of cash outflows. We hope that in the end, it will be allowed that as long as you continue to use these funds for payroll and the intended purpose, even if it's after June 30th, that will be okay. And it will just become a low interest loan that you have no personal guarantee on. So think about that type of situation and what that means to your business if you decide to go down that road. It's a 1% loan and the first 6 months of that loan will be deferred. So I just caution getting wrapped up in letting loan forgiveness sort of wag the tail of your business decisions. That probably doesn't make sense. You still need to make sure you're keeping your eye on the prize, which is keeping your business afloat during this time. So a lot of people are saying, should I give the funds back with the FAQs 31 and 37 that have been issued? We've talked a bit about that. We're not quite ready to say, yes, you should, unless you know that certification you made wasn't in good faith and you really should have taken liquidity from somewhere else. But I think that generally speaking, within our client base and the privately owned space, that most companies could in good faith say that they're facing some economic certainty because of COVID-19. We'll see what guidance we get. I'm sure more is coming in regards to those 2 FAQs that got issued in the last few days here. And then just remember, things are changing almost daily with regards to guidance. We're staying on top of it. We'll keep you informed. I think there'll be a fair amount of question as to how much legal authority the administrator, the oversight committee, and the Treasury have given how much they're allowed to stray from the original legislation and the intent of legislation. The one thing that I keep looking for is the committee reports on the CARES Act, which some are available, not as it relates to this PPP program. So I think those committee reports usually give us a lot of insight as to congressional intent. And in the end, once you see those committee reports, you can sort of gauge where Treasury is allowed to issue guidance and change some of maybe the way the wording reads. But we don't have those yet. They're not published yet. I hope we get them soon. Prepare for hindsight to be used to determine whether you need it or not. I say plan for the best, prepare for the worst. Unfortunately, that's a situation we're in today. We hope that we can bring more optimistic guidance pretty quickly here. And if you got an over $2 million loan, prepare for the loan to be audited. Make sure that you keep your documentation really tight and in order so that they can't challenge where you use those funds. That's the best advice we can give you is to just keep your documentation. Don't be loose with that. Make sure you have that pinned down. Yeah. Keep in mind, go ahead.
I would say one of the questions that's been asked here is there an actual forgiveness application process?
There will be a forgiveness application process. The legislation indicates that, the similar documentation that was required when you applied for the loan will be required when you ask for forgiveness. So you're going to have to provide payroll records. They're talking about canceled checks for rent, canceled checks for utilities. That sort of documentation will be required. A lot of people have said, hey, make sure you keep these funds in a separate account and only use that account to pay for these expenses. That's not written in the legislation, but certainly is a best practice because it'll be much easier to trace how you use the funds and where they came from. If you haven't done that, it may be a little bit too late. So I would say just make sure that you're sort of tracing what expenses you're using to pay them. And then, keep in mind, there's a lot of stress. I think a lot of business owners are concerned about Secretary's announcement yesterday on auditing the program and the FAQs that were issued as it relates to if you have access to liquidity elsewhere. Keep in mind that the program was intended, it's paycheck protection, right? So it's intended to keep businesses or help businesses keep afloat through this time and to continue to pay their employees. It's not intended to be additional working capital where you can buy inventory or pay for operating expenses outside of rent and utilities. So keep that in mind as you're using the funds and thinking about the funds. If you're doing the right things, I think you'll be okay, but just sort of keep your eye on that, the intent of the law as you continue through, and rely on us and your other advisors for additional guidance. I will say you're probably going to get spreadsheets with loan forgiveness calculations that are going to come running out now. Keep in mind that those are draft and they are likely to change as guidance comes out. New schedules will come out. People will fine tune those and they'll be a little bit more perfect. So don't panic if you get something that looks a little unlike what you thought. The same thing happened when we started rolling out this Paycheck Protection Program. I fully expect the same thing will happen as we start talking about loan forgiveness.
Yeah, and sir, we're at the 2-minute mark here, and the last questions that are really hanging out there really revolve around that question 31, question 37 issue of, do I qualify, whether I have cash on hand for a project that's in process, or I have my current line of credit, do I qualify? And I put this in my blog earlier this week. You know, it really is a subjective issue, and they talk about, you know, could anybody question your uncertainty? And I'm not sure that they can. And I use the metaphor of, when they talk about the actions that states are taking to try to prevent deaths and prevent these illnesses, you know, the result would be you'd hope you'd have less, but then you also face that kick in the pants where somebody says, well, wait a minute, you didn't need to do that much. Well, maybe we did. And so I think I kind of want to err on that side for those that are sitting there thinking, do I qualify for this loan? I think if you have uncertainty, whether it's customers, your workforce coming back, there are so many things. Tomorrow, somebody in your shop could get sick and you got to shut down and clean the place. There's just so many factors that create that uncertainty. In hindsight, you may be fine, but I don't think there can be a heavy question for your uncertainty at that time. Now, that being said, you know, that does create, I can understand the anxiety of, would I do this if I didn't know I could get the forgiveness? So I think the uncertainty that I've seen within our client base would certainly meet my expectation of a concern where this COVID-19 environment that we're living in right now, it has impacted everyone. It's impacted everyone.
I agree. I agree. Hindsight's always 20/20. You can always look back and say, I guess I didn't need it. I have a fair amount of clients though who are looking at it saying, I'd take the loan at 1%. You know, loan forgiveness is great, but I'd also take the loan at 1%. That's not my driving force.
And I got 2 things I want to cover just before we hang up on everybody. The first thing is this loan forgiveness will not be taxable income to the recipients of this income. It's still undetermined how you'll account for it on your financial statements, but it is tax-free. The second aspect is there's nothing in any of the legislation that indicates that these expenses that you use are reduced in any way. There's absolutely nothing in the legislation that doesn't allow you the benefit of deducting the costs, but also not including the forgiveness in income.
Yeah, the only thing I'll add to that, Tim, is I have read some pretty conservative bloggers or attorneys, if you will, that have said, well, wait a minute, if this is considered tax exempt income, then will these deductions really, will these costs really be deductible? I don't believe that this income is considered tax exempt. I believe it's considered excludable from income, which is a little bit of a different definition. Right. So I do believe that your costs will be deductible. I don't think that there will be a pronouncement that changes that. My hunch is they'll probably issue an FAQ that explicitly states that.
All right, and the last thing is a housekeeping item, and that is we may not have answered all your questions. We are looking to continue these every Wednesday in the month of May at 3 o'clock, so hopefully that's something you can put on your calendar. Unlike my CFO roundtables where I could say I would stick around and answer any questions you have, I am going to try to continue to answer as many questions as I can. So Brian is our facilitator. I'm not sure if that allows people to stay on board once we terminate the call and I can continue to answer the questions or not. But if I am able to, I will continue to answer questions for the next hour, at least until they're done. So we really appreciate everyone's participation. Can't thank everyone enough. And we certainly hope that within the program structure and with the SBA and the Treasury Department, we'll be able to continue to answer more questions and have more clarification on some of the ambiguities that we know are causing a lot of anxiety right now.